Hey guys, hope you are all having a great weekend. Today is going to be a little bit of a different video. There aren't any news or catalysts for GameStop and AMC this week, so instead I want to devote this segment to talk more about yield curves. On Friday's video, we briefly went over some of views on what makes investors think markets will be correcting and bearish again and why others believe that markets are set to rally. I want to talk a little bit further about economic forecasting with yield curves. I want to thank Michal Bauer and Thomas Mertens for their economic research, which I used as one of my main sources for the video. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive right in. In economics, there are many tools and instruments by which analysts use to predict future economic output and activity for nations. One of the most accurate predictors is the yield curve, which for more than 60 years, has proven to be strikingly accurate. When looking at yield curves, we are looking at the difference between long-term and short-term interest rates. Every single recession we have encountered was preceded by an inverted yield curve. An inverted yield curve, otherwise known as a negative term spread, reliably predicts low future output growth while also indicating a high probability of a recession. Knowing this, let's look at what has been happening lately. The S&P 500 and the Nasdaq both had their very best week since November of 2020, and the question right now on everyone's head is if these rally will continue to stick or if this is just the calm before the storm. Using fundamental data and comparing it to previous similar situations, the current prognosis is that as things stand, we usually dive deep into a bear market. The geopolitical risks, the rising interest rates, the out-of-control inflation with a Fed that believes and even hinted will continue to grow in coming months, the United States is in a tricky spot right now. The Fed decided to raise interest rates, with the first quarter point taking place last Wednesday. Ukraine is an absolute disaster, making markets very volatile and causing chaos in the energy sector. In fact, the energy sector is now being considered the single worst factor causing inflation to grow so quick, already at a 40-year high. But the worst part, which we alluded to on Friday, is the Treasury yield curves, which are inverting, and this is where most of you should be paying close attention. As you can see in the image, in every single bear market, the common denominator has been rising rates, inverted yield curves followed with geopolitical tensions. Right now, we are currently awaiting a recession within 12 months if this is to be accurate and stand the test of time, which has been since year 1946. So even with all of these clear indicators that a recession is coming, why are so many economists and investors so bullish about the short term, or at least 2022? Well, every single recession is unique, and there are different factors affecting the economy at such times that cause it to behave and react differently. Right now, as measures used by the Fed dictate, the economy is enjoying good levels of consumer spending, a very robust, strong labor market, and most importantly to them, better than expected corporate profits. They are also citing that even though the spread between the 2-year and 10-year yield has narrowed, the 10-year yield compared to 3-month Treasury bills is steepening. The average bull run in the S&P 500 typically lasts 5.8 years, and the current bull run is just 2 years old from that 2020 fall. Now, determining where markets go is impossible, but I will give my input on things. Friday's quad witching was very weird and did not follow trends with a bearish performance, but I think there is a reason beneath the simple excuse that markets are already oversold and people are buying the dip. In fact, I am now more bearish for the later half of the upcoming week than I have been before, and I think you will agree with me. The term market manipulation is thrown around super frequently, usually as a way to explain why things did not happen the way one anticipated them to, but I do believe that, based on options data, market manipulation is the sole reason why during the last 4 trading sessions beginning on Tuesday of last week, we have been rallying. You see, looking solely at S&P 500, we were trading at around 415 to 416 towards the beginning of the week. We experienced a monster run of almost 30 points up, reaching over 445 by Friday. This is incredibly weird considering that last week we couldn't even move past 430. Powell had the committee on Wednesdays, and after that, SPY and other benchmarks went to the moon. I mean, guys, we haven't seen a run like that since November of 2020. It is when we start looking at volume that it becomes even more weird, because there was very small bullish volume relative to the price performance we saw, which means something is very off. And this is what I think happened. Big money saw the bearish sentiment across the market. Remember, they have analytics and oftentimes have deals with brokers and financial investment websites which give them data to see how people feel about the markets. It was only a week before that reports came in that people had a bearish outlook on the economy, which caused a market dip after all. Even on a poll I did, almost 70% of people think markets will fall, and knowing this, one can more than not correctly assume that positions by retail will most likely be bearish. So here's what happened. Wednesday, Powell announces the quarter-point rate hike and markets go up. Short sellers don't sell because they are certain, especially with quad witching on Friday, that the markets will again begin to fall. Then Thursday comes and again, the markets don't even revisit 430, they keep going to the moon as if the world is fine. Investors at this point think stocks are way overbought and that on Friday, it is impossible for stocks to not fall, but that is not what happened. On Friday, there was a massive bull run, and all the short sellers were caught by surprise. This bull run was implemented by none other than the big money of institutions, who collectively saw retail shorting stocks and decided to create a market rally that would push stocks up, with the intention of slowly starting to have brokers margin call these shorters this week. I think that in the beginning of this week, we could potentially see another bull run as big money will surely push stocks up to cause shorters to close out their positions, essentially causing a short squeeze, but they too will begin collecting profits, eventually leading to another huge dip. The reason why they will not hold is because they too know that there is very little buying volume happening. They know that investors are scared and aren't as confidently in the markets as they were at the beginning of this year. They will trap investors who think this rally will last and who decide to buy high. This will force shorters to close out their positions, eventually leading to a small short squeeze which they will then take opportunity to sell and let markets fall. Under no parameter, metric or statistics, especially after looking at options data, can we confidently say there was enough volume to push the S&P 500 up the way it rallied this week. There was only a very tiny amount, which indicates to me that this is all fluff right now. I think we have yet to test the real bottom of the market before we begin moving up. Looking at overall market stats, liquidity is the markets is terrible. The spread between the bid and the ask continues to widen, which can lead to a lot of volatility. The top of the book for the S&P 500 futures has narrowed to its worst levels since the start of the pandemic. And to really make this paramount to you, why don't you take a look at NASDAQ and look at the stocks making new lows? Under no conditions should NASDAQ have rallied when so many of its stocks are failing this much. This is a prompted up performance done by market manipulators who have all the data in the world to see what retail is doing and to bet against them big time. And everyone who got caught shorting the benchmarks is about to start getting margin calls because big money will keep on pumping these stocks until they force a short squeeze which they will use to collect huge profits and let the stock prices dump. As such, I will not be buying any stocks long term for the moment, only day trading. I am not bullish on the stock market yet, and right now, even though I understand why bulls think we are set to continue moving up and out of this bear market, I disagree with them thinking we have seen the bottom yet. I think we are set to fall. All the data doesn't align with the stock's bullish performance, which makes me bearish, and the fact that the real data with yield curves all points to a recession happening in the next 12 months, which has actually never failed to be accurate since the 1940s, makes me even more bearish. I want to buy GameStop, but I am waiting for a dip below $80 again. For AMC, I wouldn't touch anything above $14 either, but that is just me. Again, this is just my opinion based on a uniform of collected data I have compiled and gone obsessively over this weekend. Let me know what you guys think below. GameStop and AMC are my ticket out of this world. I only trust them long term right now, and I will continue buying the dip as soon as this fake bull rally ends. Again, I am open to different opinions, which I compel you guys to share with me either here in the YouTube comment sections or in my Discord. Let's talk about AMC and GME. As you know by now, AMC had a fantastic run this past week. Coming back from beneath 12.90 to surpassing 16 by Friday and closing at 15.80. Biggest support are at 15.10, 14.10 and 13.20. Resistance will be met at 16.50, 17.32 and 18. Again, you all know what I said. Markets will continue this little bull run as big money manipulates stocks to go up to force shorters to close out. Once they close out, they too will pull back as the buy volume is so small they know markets have more room to fall. With GameStop, it also experienced a rally. went from 75.51 at its lowest after that earnings call to closing above 90 by Friday, almost reaching 100 again. This is unheard of that they let this stock behave so bullish, which is more confirmation to me that this is all a lie. Support will be found at 89, 85 and 82. Resistance will be met at 97, 100 and 104. Cannot say it enough, come join my Discord already. I want you guys there this week. Tons of stuff could be happening, so let's stick together in my platform, which is shill-free and open to discourse. You can ask me questions there too. We have a very active community of almost 4,000 members there, so feel free to come join us. There will be tons of updates and information being shared there every hour in relation to the markets, the war in Ukraine, GME and AMC and much more. I will leave a link down in this video's description. If you want to support this channel, I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Enjoy the rest of your day, keep on buying the dip and to the moon.